Every once in a while, when I'm going through all these different interesting storylines in the Canadian stock market, I find something that's too good to be true. The stock yielding almost 10% and has a 50% upside potential in the not so distant future. Now, when I see something like that, I'm instantly skeptical. But the more I dived into this story and the more I talked to people about it, the more I realized that this might actually be a 10% dividend yield stock that has real upside and that isn't overvalued. Welcome to Golden Nudge Investing. Today we're talking about PHX Energy, formerly Phoenix. Now I'm going to use the word Phoenix quite often because it's catchier, it's quicker, but PHX Energy, you'll find it on the stock market, the TSX PHX, and I seriously recommend you check it out, do your own research if you want to buy this stock, but I personally am really impressed with what I found. We've got an article from Seeking Alpha I'm going to use here to kind of organize us as we go through this stock because there's so much to talk about here. What exactly the company does, how they can pay out such a crazy dividend, and how they have real upside potential, right? Like where the valuation is, all that. Going through an article like this is going to help me organize those thoughts. And the author here did a really good job of going through their own investment thesis that really helps me out. Now, as we go through the summary here, you see that they talk a couple things that are really important. Robust cash flows, strong balance sheet. Super important for us as dividend investors. Has a leading market position, top tier clients. Now you might notice right there, they're not talking about their own assets, right? They're not talking about, oh, well, they own all these oil assets the way that we've talked about a lot with some of these other E&P companies. They do something a little bit different, and that's really interesting. They have great free cash flow yield and a 9.5% dividend as of writing. It's actually over 10 today as I record this video. Obviously, that makes it a very attractive company and has significant upside potential even under conservative assumptions. So if we're not saying that the world goes fantastic for this company, they still have upside potential. They also have the same kinds of risks as most of the oil industry, but they've proven resilient through recent downturns and they've maintained loyal customers. And while there is near-term choppiness, that is part of the reason why they have such a great PE ratio, why they have such a great dividend yield right this second. Because of some short-term headwinds, they have long-term potential. And that's exactly the way I personally invest. And a lot of people here on the channel, a lot of people in the community here like to invest. That's kind of what we're looking for. And this is a really interesting, like, small, unrepresented, underappreciated stock, right? This is not on industrial investors or, even big oil and gas investors' radar. People don't see this stock. And as retail, that means our opportunity is way better than in, let's say, 2 years when you're going to see this thing on CNBC, on BNN. Now, let's go through the introduction. Now, the super important thing. So what exactly is it that they do? That's probably what you're asking the screen right now. And you'll see on the screen, they're the largest independent supplier of directional drilling services in the onshore North American market. And 18 of the top 20 energy companies are currently their clients. So huge customer base. And think about exactly what they do and what they benefit from, right? They provide the directional drilling equipment needed to keep up this really quick turnover in all of these shale oil markets. And remember, we're seeing expansion of these outside of the Permian. Yeah, the Permian's slowing down, and that's probably not bullish for them in the longer term, but that doesn't mean that they're not going to see the same drilling. It just means that those companies drilling are slightly less profitable. But we are seeing more expansion, specifically up here in Canada, the Montney and the Duvernay. So they have some really interesting Canadian opportunities. Obviously, based on the fact that so much shale oil is down in the States, they got a 75% of the company's revenue generated in the US, and they have a net debt of $12 million, which is less than 0.1 times EBITDA, which is awesome. That's fantastic. Company's Canadian listing is the most liquid with average daily volume of 106,000 shares, which, for reference, if you're not somebody who trades often and looks at liquidity, that is nothing. That is nothing trading, right? Even like mid-cap US names like retailers can trade 5-10 million shares a day. So seeing 100,000 is quite small. Really interesting. And you see this author obviously wrote this in July, so just about a month ago now. Stock was trading about $8. And so all of the math that they're going to do is based on an $8 price valuation. Look at the stock today whenever you're watching this video and see where it's at. As I record it, it's just about in the same kind of range, right? We're not talking about beating out of this sort of mid-high single digits. range, but we're not talking that it's, down by 4 again. So Q1 results, which is actually really positive, interesting results. Cash flow performance really well. They saw the revenue increase 17%, which is awesome. Gross profits of $40 million. That means a gross margin of 20%, which is awesome. However, that is a little compression from 22. Still, that's pretty great. Operating expenses decreased a little bit. This allowed the company to report a pre-tax income of 25 million Canadian dollars, which is better than last year. And you'll see that, right? Revenue is up. Now costs are up a little bit, but profits also up. So you see all these things are working the right way. This is how you want the company to be going. You see earnings before income is higher, income taxes are higher, and net earnings are higher. So everything just about beats compared to last year. And taking taxes into consideration, net profit of $20 million, that's an EPS of 44 cents, which is really good. Operating cash flow is about 10 million on a reported basis. That's 60 million of working capital investment and excludes 900,000 Canadian lease payment, 0.9 million, they put it there. On an adjusted basis, operating cash flow is approximately 26.6 million Canadian dollars. And you see where that is. So their operational cash flow is at 20. And then as you go down the list, you see all sorts of numbers. Feel free to pause and go through anything that you're interested in. Really interesting. You see there's so many lines here. They've got a lot of different things going on. Because again, this is not just an E&P company. They're not just producing oil. Now, capex here was approximately 28 million, but PHX Energy has an excellent track record of selling older, I assume, equipment. They say order, but I'm guessing that's a typo. As you can see above, generates about 11 million in cash proceeds, which benefits the company, right? And so they indicated it resulted in a gain of almost 8 million on the sale. So that's not a unique case. They did the same kind of thing. Q1 24. It seems like they're going to continue to do that. So there's sort of this constant, money out in capex, but also money in selling older equipment. And you got to assume that the equipment every year is getting better. Otherwise, they wouldn't do this. The trend is clear. Market value of the older equipment tends to be higher than the book value. So it is genuinely beneficial. Holding it on the books isn't worth the same amount as selling it. That's also really interesting. And they clearly understand the game here. Right? These guys are not fools. They understand how to benefit their shareholders the best. I think that's an interesting point because as we go through this article, we're going to get to that 10% dividend yield. And sometimes, in fact, not even sometimes, I would say almost all the time, when we shareholders look at a crazy high dividend, our first thought is, what's the catch? What is it the management's doing wrong that's going to come back to bite us? Think about BCE 6 months ago when you were looking at like a 13% dividend. There were plenty of mom and pop retail investors saying, oh my God, I know this company. This is great. But a lot of us who are seasoned investors, who are long-term investors, we look at that and immediately knew management was making poor choices. But here, it looks like management actually is just maximizing everything they can. They both understand their business, they know exactly the steps they need to take, and they're benefiting shareholders, which is huge. Now, obviously, a big part of their capex is funded by this asset sale, which is important, and it substantially increases the likelihood and market value of the drilling equipment on the balance sheet is higher than the book value. It's also, so if they sold everything, it's probably worth more than they're currently getting for it. And thinking about the book value of their equipment right there and the market cap of the company, that's like, we're talking a lot of money could be made selling this equipment. Obviously, you don't want that, right? Because obviously they wouldn't be able to operate, but they are in a good position in that sense. Important to understand total capex includes growth. Company's guided for sustaining capex of 28 million, which is about 7 million a quarter. So if they exclude growth, it would take the asset sales out of the equation. Underlying sustaining free cash flow of the first quarter of this year was about $19 million. So basically, just for them to exist, currently, they profit $19 million a quarter. If you divide that by the current share count, sustaining free cash flow of 43 cents a share. There's also some seasonality. If you look back at full year 2024, operating cash flow is about 79 million, which normalized sustaining capex about 25 million a year. So the net free cash flow is about 54 million, and that ends up at $1.20 a share. That was 2024, although they've only reported one quarter of the adjusted EBITDA in full year 25 was already 16% higher. So you could assume as they go through that there is more profit coming in and there's more free cash flow coming in. So if you're looking at an EPS of about $1.30 a share, and that excludes again the sales of equipment that they've used to boost their free cash flow every year. So they're making a lot of money. Their margins are good. And they have a lot of money coming per share. There's a lot of, there's money on the table here. And it looks like shareholders understand that. Because as you go down, you'll see that they're paying out 20 cents per share on a quarterly basis. Now, if you think back to how much they are cash flowing, there's still a lot of free cash flow there. That's a well-covered dividend, even though it's incredibly generous. And at the time of writing, that's about a 9.5% of the current share price. So they've spent in excess of 50 million of net free cash flow on share buybacks in the last 2 years. So on top of 10%, they're returning more cash to shareholders because they have so much cash and they're not worried about it. Again, they have a huge amount of equipment on the books. They have a huge, great revenue machine they've built out for themselves. They're cash flowing well above what they're paying out in dividends. So they literally just have extra free cash flow to return to shareholders. And they have and that's again sustaining. That's assuming they never optimize the sale of old equipment, which they clearly are doing and cash flowing more for. So it's just fantastic. They also use the buyback allowance to bring shareholder returns in line with the return of capital strategy, which targets up to 70% of the annual excess cash flow to be distributed to shareholders in a combination of dividends and share buybacks. So if you think about it, if last year they paid out about 80 cents Canadian shares, and this year they're looking at an underlying free cash flow of about $1.50 a share, you could actually see the dividend increase substantially, or share buybacks increase substantially. 70% of $1.50 is a lot more than 80 cents. So you're looking at significant buybacks, maybe again, bringing the opportunity for huge share price appreciation, which hasn't happened since the writing of this article. Actually, if you think about it, the current dividend yield is much higher, which means the share price is down compared to recently. So really, really interesting. Now, here's an interesting part. This is a contrarian idea. The author says, hey, this is an established player, but this is a contrarian idea. And if you don't know what that means, obviously contrarian means you're pushing against what is considered common sense or common knowledge in the market. And contrarian investing has always interested me a little bit, especially if you've ever watched things like The Big Short. You've ever heard of Michael Burry, right? Quite a contrarian guy. He bet against the market in 2008, made a fortune doing it. Now, I'm not saying we're in 2008, and I'm not saying that just because we're buying this company, we're Michael Burry, but it's always interesting to see what opportunities the market has turned its nose up at. I think the most recent really good example that I have that I actually took advantage of, but not to the tune I wish I had, is Meta. Back in 2022, this was under $100 a share. And we're talking, I sold my shares for almost $700 a share in the span of 2-3 years. So the market turned its nose up. There was a huge opportunity. And as a retail investor, we can take advantage. So I always love to see this in stocks that I'm looking at. What is it that the market doesn't like? And do I agree with them? Because again, they're offering me a discount. So if there's nothing wrong with it, I should take advantage. So let's see what the author says. PHX Energy Services provides horizontal and directional drilling services. Since it was founded in 1995, it has grown out to be a tier 1 company in its field as it continues to invest in R&D. It's built up strong relationships with oil and gas producers in the past 3 decades. Strong cash flows in the past few years allowed the company to embark on serious expansion. They spent north of 83 million Canadian dollars on new equipment last year, and they're on track to spend 65 million this year. It's about 30% higher than the current depreciation and amortization rhythm. So they're expanding. Basically, at the expected rate that the stuff is going to depreciate, and at the expected rate they would need to purchase new equipment, they would be spending 30% less. So they have a bunch more spending going on. So obviously that means they want to expand the business. Current depreciation pace is quite aggressive, given the company's excellent history of selling secondhand assets at triple-digit premiums compared to the book value. So basically, and you look at all the things in here, are super interesting. I recommend you check out what exactly it is they do. Very technical. This video would be incredibly boring and very slow if I stood here and tried to explain to you exactly each piece of equipment. But if you're into that kind of thing, and I am, I would recommend you go check it out because it's really cool. You can find just about everything online. Some of it you're going to have to dig deep for. And there were some things that was I was down the rabbit hole figuring out exactly what they're doing, but I recommend it. I think it's really cool. Now, risks and valuation. The risks are going to be obvious. The valuation is really compelling. That's just my opinion. 2 main risks, obviously. First risk is the oil and gas price. because lower prices reduce the appetite of producers to drill more wells. We've talked about this a fair few times. I was going to say a lot, but a couple times at the very least, because we've talked about the decline of US shale. It's one of the major themes that has supported our thesis in investing in Canadian oil sands, which is not what these guys deal in primarily. Canadian oil sands are their own sort of business here. It's very different than this directional drilling that has really been made famous by the US shale oil boom and the fracking boom down in the United States. Now, while we do talk about the Permian Basin slowing down, that does not mean that shale oil as a whole is decreasing in North America, because other basins have started to ramp up, including outside of North America. And importantly, Canada has a huge volume of shale oil in the Duvernay and Montney that is just ripe for expansion. And obviously, what is it that we're trying to do? Sort of as a nation, these nation building projects are trying to promote expansion of these areas, expansion of the Duvernay, expansion of the Montney. That's what most people expect to see the next sort of couple of years. So I think they do have some potential there, even though we are bearish on the Permian and US shale's sort of 5 to 10 year future. I think the next couple of years, they're quite safe in their current model. And by the time you see US shale start to really slow, you're going to see Canadian start to boost. On top of that, think about one of the main risks that you run if you own big E&P producers. You worry about the price of oil dropping because new oil is found in other markets. Well, let's say we found new shale oil reserves down in places like Central South America. Who might be a really obvious producer or a really obvious supplier, at least, of directional drilling equipment? PHX. So I think they do have some insulation against the main risks of oil and gas prices falling, thanks to the decline of US shale. Now, obviously, if the oil market completely dissolves, which I don't think any of us are predicting, considering we're talking about these companies as investment opportunities, obviously they'd be in real trouble. But I think they're more protected from this risk than most of the actual oil producers. So I just wanted to put my own caveat on that. And the author also gives the same kind of point. Even in 2020, they would have been profitable if it hadn't been for an impairment charge. Excluding that charge, they would have generated income when oil prices hit negatives. So really interesting. That's one of the worst years in the company. If you look at any chart, any company's financials that is in this space, 2020 was brutal for them. Subsequent years, profits recovered, and they reported great income. It also confirms their argument that a tier 1 service provider customers are loyal and don't just switch to cheaper competitors. So tier 1 is where they want to be. This is their own investor relations, right? And there's a significant barrier of entry. So they're saying, look, unlike so many companies in the space, we have a moat. We are the tier 1. People trust us. People want to use us. And we are the best at what we do. Really, really interesting. Obviously, there are some variables talking about US tariffs. They rely on a Canadian-US equipment flow. I'm not too worried about this. You think about some of the people who were really, really pro-Trump down in the States. It was the oil and gas industry. Would he want to damage his own drilling industry? No. Now, then again, there are always things caught in the crossfire when you're trying to make bigger political statements, but I think more or less it should be pretty good. There's also a FX or a foreign exchange risk with the Canadian dollar increasing against US dollar. If they make a lot of their money in the US, comes to Canada and the Canadian dollar is worth more, that's actually worse for them. So it could take a few percent off. Investment thesis. They've had an excellent first quarter with record revenue. Remains to be seen if the rest of the year will be equally strong. Oil price decreased during the first part of the second quarter, might have an impact. Then again, you did see WTI jump after that, so I don't think they're too worried. Calculations still a bit more conservative than consensus estimates, but they're expecting EPS about $1.15, net free cash flow of about $1.50. Means the company's trading at an 18% free cash flow yield. Investors get paid just about 9.5-10% a year, which is fantastic. Balance sheet is very robust. They have a tiny debt position and a positive working capital position. Next few months and quarters could be choppy. It creates a great opportunity to build a long position. Something we talk about lots in this industry. Something that people seem to ignore. Because so many people are saying, oh, haha, look, you wanted to invest in these companies and it's been 6 months and they're not up. You haven't made a huge amount of money. And I'm like, okay. But to be fair, we're building long-term position. We're holding these for 5-10 years anyways. Why would you check the price of your home 6 months after you bought it? Then why are you checking the price of this? Are you planning on selling? Do you need the cash right now? Because if you do, then this is probably not the move. But if you want to invest in something for maybe 5, maybe 10 years, at least catch the next cyclical bull run, because this is definitely a cyclical company, you're getting paid a great amount of money to sit on your hands and hold. I think they have a great longer term position. I think this is a fantastic example of what I talked about just the other day, of looking for small, misunderstood opportunities. And this is one that is in an area of the market close to home. Lots of us here on the channel understand the Canadian oil and gas market. We understand what's going on. We're really tuned into the opportunities that are presenting themselves. This is an obvious pick. I think it is small. It has a great PE ratio. We're talking single digits. It has very minimal coverage. You're not going to see plenty of analysts covering this thing. There are literally 2 articles available right now on Seeking Alpha. This one and one from 2019. When I say underrepresented, I mean literally people don't see this stock. It doesn't show up when you look for Canadian oil and gas. It's so far down the list of market caps that people ignore it. And I think that is why it's so cheap and it's such an interesting opportunity. I've been looking for small cap stocks to add to the portfolio. I've been looking for ways to boost the income generating on this dividend portfolio. And I think this makes sense. I think this makes a lot of sense for me. I think it's something that I'm going to start adding to. We'll see how the next 6-12 months goes, right? I could find myself buying at a much better price in 6 months, but I am happy to watch this stock go down. I think that is a good thing for my portfolio, a good thing for me as an investor, because I'm holding this thing for the next cycle. And the next cycle is not happening today. It's not happening tomorrow, but it will come. And when it does, you're going to see this thing trading for a double-digit share price and still returning crazy amounts of value per share. Think about that. 70% of $1.50 of their free cash flows. You're talking at least, if they're not bumping the dividend, at least $20, $30, $40 million buyback on a company that's worth a couple $100 million. I think it's in the 300s as I film right now. So there's fantastic opportunities here. It's an interesting stock. It's the right kind of share price. It's the right kind of valuation. I'm checking it out. And honestly, I think you should, obviously do your own research, but I think you should check it out for yourself. So that's about all I got for you guys today. If you're interested in hearing my thoughts about a much larger Canadian oil and gas stock, one of our personal favorites here on the channel, check out this video where I talk about CNQ. And as always, if you like the videos, please subscribe. And if you like what we do here on the channel, stick around for the next one.